Have you ever wondered if you can start investing with just $50 a month? Or maybe you've been curious about how to grow your money, but the idea of picking individual stocks or bonds seems overwhelming? Well, you're not alone. Many people feel the same way, and that's where mutual funds come in. They're one of the easiest and most accessible ways to invest. And today, we're going to break down exactly how they work and why they could be a great option for you. By the end of this video, you'll understand what mutual funds are, the myths surrounding them, and most importantly, how to use them to start building your wealth. Whether you're just starting out or looking to improve your current investment strategy, we've got you covered. Before we dive in, don't forget to hit the like button and subscribe to our channel for more helpful tips on managing your finances. Trust me, you won't want to miss what's coming next. Understanding the basics. What is a mutual fund? Let's start with the basics. A mutual fund is essentially a pool of money collected from multiple investors, which is then managed by a professional fund manager. This pool of money is invested in a variety of securities, such as stocks, bonds, or other assets, depending on the fund's goal. Think of a mutual fund like a basket filled with a variety of fruits. Instead of buying individual fruits, stocks, or bonds, you're buying the entire basket, which is a mix of different types. This way, you're not putting all your eggs in one basket, and the risk is spread across many different investments. Why should you care? Mutual funds are popular for a few reasons. Diversification. With a single investment, you're exposed to a variety of assets. This helps reduce the risk that comes with investing in just one stock or bond. Professional management. The funds are managed by experienced professionals who make decisions on your behalf, saving you time and effort. Accessibility. Many mutual funds have low minimum investment requirements, meaning you can start investing with as little as $50 a month. Key terms to know. Net asset value, NAV. This is the price per share of the mutual fund. It's calculated at the end of each trading day, and it reflects the total value of the fund's assets minus any liabilities. Expense ratio. This is the annual fee charged by the fund manager, typically expressed as a percentage of the fund's assets. It's important to keep an eye on this as it affects your returns over time. Common myths and misconceptions. Myth number 1. Mutual funds are too expensive. One of the biggest myths is that mutual funds require a large initial investment. While some funds may require minimum investments, many allow you to start with as little as $50 or $100. And unlike individual stocks, you don't need a ton of capital to get started. Myth number 2. Mutual funds always have high fees. Yes, some funds have high fees, but not all of them. The expense ratio varies by fund, and there are plenty of low-cost options available. Index funds, for example, are a type of mutual fund that tracks a specific market index and tend to have much lower fees compared to actively managed funds. Myth number 3. Mutual funds are only for experienced investors. Another misconception is that mutual funds are only for seasoned investors who know the ins and outs of the market. In reality, mutual funds are a great option for beginners because they offer diversification and are managed by professionals. You don't need to be an expert to benefit from them. Myth number 4. You can't access your money quickly. Some people believe that mutual funds lock up your money for years. While it's true that they are generally long-term investments, you can typically sell your mutual fund shares at any time, just like stocks. Although there may be tax implications for short-term gains. By debunking these myths, we can see that mutual funds are accessible, flexible, and suitable for investors of all experience levels. How to apply this knowledge. Step 1. Determine your investment goals. The first step in using mutual funds effectively is understanding your own financial goals. Are you saving for retirement? Do you want to grow wealth over time? Your goals will determine the types of mutual funds that are right for you. For instance, if you're saving for retirement and have a long investment horizon, you might want to look into equity mutual funds which focus on stocks. If you're more risk-averse and looking for stability, bond funds might be a better fit. Step 2. Research different mutual funds. There are thousands of mutual funds out there, so it's essential to do some research before choosing one. Look at the fund's historical performance, expense ratio, and the manager's experience. You can find this information in the fund's prospectus, which is a document that gives you all the details you need. Step 3. Start small, diversify, and contribute regularly. You don't need to invest large sums of money up front. Start small and build your portfolio over time. Many mutual funds also allow you to set up automatic contributions, so you can invest a fixed amount regularly. This strategy, known as dollar cost averaging, can help reduce the impact of market volatility by buying more shares when prices are low and fewer when prices are high. Step 4. Monitor your investments. While mutual funds are considered low maintenance, it's still a good idea to check in on your investments periodically. Make sure they're aligned with your goals, and if your life circumstances change, such as getting closer to retirement, you may need to adjust your asset allocation. If these tips are helpful, give the video a thumbs up to help others find this content too. Advanced tips and strategies. Strategy 1. Asset allocation. As you become more comfortable with mutual funds, you can start fine-tuning your portfolio with asset allocation. This involves dividing your investments across different asset classes, stocks, bonds, real estate, etc., based on your risk tolerance and financial goals. A balanced allocation can help you navigate market fluctuations while maximizing returns. Strategy 2. Dividend reinvestment plans, DRIPs. Many mutual funds offer a dividend reinvestment plan, or DRIP. This allows you to automatically reinvest any dividends you earn back into more shares of the fund. By doing this, you're taking advantage of compound interest, which can significantly grow your investment over time. Strategy 3. Tax-efficient investing. Taxation can eat into your investment returns, so understanding how taxes work with mutual funds is crucial. For example, if you hold mutual funds in a tax-advantaged account like an IRA or 401k, you can avoid paying taxes on dividends and capital gains until you withdraw the money in retirement. Strategy 4. Actively managed versus passively managed funds. While actively managed funds have higher fees, they are managed by professionals who aim to outperform the market. If you believe in the manager's strategy, they can offer significant returns. On the other hand, passively managed funds, like index funds, have lower fees and aim to match the market's performance. Both strategies have their place in a well-diversified portfolio. Today, we've covered a lot, from understanding the basics of mutual funds to debunking common myths and offering actionable advice for getting started. We also explored some advanced strategies to help take your investment game to the next level. The key takeaway here is that mutual funds are a simple, effective, and accessible way to invest, no matter your financial goals or experience level. By starting small, diversifying, and sticking to a consistent investment plan, you can set yourself up for long-term success. If you found this video helpful, make sure to subscribe to our channel for more in-depth content. And don't forget to share it with anyone who could benefit from learning about mutual funds. Thanks for watching, and good luck on your investment journey.